for Southeast Asia in 2017, our title there is Clearer Skies in the Archipelagos, which really to say that we are more optimistic on Indonesia and the Philippines, which we think will do relatively well despite a more uncertain global environment. And that will really set them apart from the rest of the region, which are more open and more exposed to these risks. So let me talk about these two groups. So starting with Indonesia and the Philippines, our growth forecasts are still pretty strong. For Philippines, we have it at 6.3, which would make it still one of the fastest growing economies in the region. And we've got Indonesia accelerating from 5.2 this year to 5.6 next year. Which again is an interesting uptrend because there are quite a few drags from commodity prices, but also weak exports. So what we're really saying here is that with both these countries, it is domestic demand that will be really the main growth engines. And within that, let me highlight a couple of things. So one, we think infrastructure spending by both governments will be a major theme next year. Our expectation is these countries will make more progress than they have in the past in rolling out the infrastructure projects. Both governments are very focused on making progress. And I think the strategy will also change. They will get more involvement from the local government and decentralize the disbursements, which I think would be it's both necessary, but also at the same time make it more effective in terms of execution. In terms of the other things, we also expect reforms in these countries to continue to have strong momentum. If you look at, for example, standard metrics like the World Bank's ease of doing business, Indonesia, for example, has done very well, gaining about 26 spots in the last 2 or 3 years. In contrast, Malaysia and Thailand have lost a few double-digit spots. So there is quite a bit of momentum and reforms, and we think it's going to continue. Again, there's quite a bit of focus in terms of cutting red tape, liberalizing some sectors, but also making the business climate a bit more friendly. So the combination of higher infrastructure spending and reform momentum continuing will, in our view, crowd in more private sector participation, and that will enhance further overall investment spending and therefore support domestic demand. Now turning to the second group, so it's not just their exposures to trade and financial channels. One thing that we think will be a key issue for these countries will be the policy space to be able to counter what Rob said earlier as the risk of capital outflows because of higher rates in the U.S. So because these economies have output gaps that are going to be even more negative next year, I think that will limit extremely the central bank's capacity to respond with hiking rates. And that's also already being exacerbated by the fact that, household leverage in these countries are much higher compared to what we have in Indonesia and the Philippines. Malaysia is interesting in this context because, as you all know, there's quite a bit of fiscal constraints over there. The government is trying to do fiscal consolidation, which would again put the onus on supporting growth on the central bank. We have B&M cutting rates, but again, that's only by a couple of times and not successively, but rather spaced out. Again, to highlight that constraint, they can't do much because the currencies might also be under pressure. And then the final thing I would say for these countries is there is the ongoing intersection between these external problems with the domestic structural constraints. So, for example, Thailand and Singapore have aging populations, and Thailand will be interesting next year because that's when we start to see the labor force starting to shrink, and that causes a lot of problems as we've seen in Singapore in terms of tighter labor markets. it will be very hard as well in that environment, especially with higher external risk for businesses to try and continue to increase investment spending, which would in turn be a problem for productivity growth in these countries, which have already been declining. So overall, it's a very tricky environment for these countries to navigate, and we're not sure if they have all the policy leeway to be able to respond effectively.